Hello everyone. The job market is not looking very healthy. As per as the latest release from Bureau of Labor Statistics this Friday, the non-farm payroll unemployment number shrunk by 23,000 and unemployment rate stayed at 4.1%, came down from 4.2% earlier month. In this video, we are going to discuss key findings from this July job report, market reactions in terms of Federal Reserve's and stock and bond markets reaction. We'll also discuss sector by sector hiring breakdowns and impact on upcoming Federal Reserve's decisions, wage growth trends and as far as in industry, labor force participation, as well as we'll discuss historical revision and trends and macroeconomic factors behind the losses, and we'll also discuss about mortgage and consumer lending rates reaction. So please stay tuned. Now, according to this report on Friday, from the report from Bureau of Labor Statistics, the non-payroll unemployment number came down by 23,000 and the unemployment rate fell to 4.1%, slightly below, used to be 4.2% in the month of July. And here is this graph showing those unemployment rate seasonally adjusted in the month of July. And similarly, on the right side, the non-farm payroll adjustment over the month and month changes, seasonally adjusted. Now we are going to be discussing more details about these findings of this July job report. The payroll number is dropped by 23,000, falling well short of economist expectations for a positive growth. Unemployment number stayed at dropped to 4.1% from 4.2%, driven by decline of people actively seeking work rather than job gains. And there's been huge revisions for May and June. Payroll numbers were revised down by a combined 103,000 jobs. And important thing is the wages average hourly earning rose just by 2 cents, 0.1% to $37.62 an hour, bringing the 12-month wage increase is just about 3.2%. And the sector impact is that government position jobs fell well below 53,000. The retail and hospitality showed softness, and the healthcare growth slowed down. And the market reaction has been that after the Federal Reserve, the expectation cooling down reduced the market expectation of an aggressive interest rate hike in September. It cooled down. And the stock and bond market, the major indices, including S&P 500, Dow Jones Industry, the Dow Jones Index, and NASDAQ, it all rose following the news. It spiked up, and the treasury yield moved lower because the treasury yield had actually spiked quite a bit last few days, almost to a very high level to 4.7%, the 10-year treasury, and 30-year treasury crossed over 5.3% last couple of days. Now, in terms of sector to sector breakdown regarding this job market is that the healthcare assistance number, it added only 22,000 jobs. Construction surged by 22,000. Professional and business services expanded by 18,000. Information technology joined modest 11,000. So those are the positive ones. But the negative numbers, like the job shrunk, was manufacturing. Actually, sorry about that. Manufacturing increased by 5,000 jobs as well. But the retail trade lost by 19,300. Leisure and hospitality, it sharply dropped by 40,000. And government job, like I mentioned, plummeted 53,000 positions, mostly stem from local government and educational cutbacks. So in this particular section, 53,000 jobs were eliminated. In terms of economic Federal Reserve's decision, that current benchmark stays at the Fed rate at 3.5% to 3.25%, and the policy members basically dissented in terms of hikes. But after these job reports, the majority decision they paused it. So the inflation still dominates because of cooling. But despite of this cooling labor market financial institute and bank other Bank of America still expect that there's going to be a Fed they may still rate hikes later this year in upcoming if the CPI numbers basically that's going to be coming up next week, if it reveals a sticky inflation. Currently the inflation has been pretty sticky for last couple of months because of the oil and other related gasoline, airline tickets, energy, all basically impacted from the Iran US war and the closure at Strait of Hormuz. Now, in terms of the wage growth trends, is showing momentum at 2 cents last month. So the monthly hourly wage is at $37.62, and the annualized number, the increase wage increased by only 3.15% for all private workers. But in terms of the blue collars, they did a little better. So the blue collar jobs, their wages increased to by 3.22% over the 1 year period. So they're slightly better than the non-blue collar people. Now the historical trend revision was that the May downgrade actually the estimate was dropped from originally from 66,000 to 63,000, and similarly for the June the correction was revised number to 37,000. Reducing the month net growth a meager 20,000, and cumulative impact is just 103,000 jobs were erased in this last 3 months. That's pretty significant, big number of loss that has been erased from the labor market, erased out of this economy. So in terms of macroeconomic factor behind these losses are because of the Middle East war, because of this energy shocks, because of this the conflict is still going on, there is no resolution. So the energy price again spiked up after the MOU was signed between the US, but that was basically eliminated, and everybody is both the parties were in conflict. So oil price went up to almost $80 per barrel, the West Texas. And whenever with that there is a lot of other oil related products, the inflation came up. And in terms of tariff also, President Trump actually announced certain tariffs in last few days, and that's fundamentally driven up raw material prices, supply chain impact, including companies basically hitting profit lines, and the companies have basically the companies have frozen, they are freezing hiring and outright staff reduction to some extent, some other companies, to protect their bottom lines. And the immigration crackdown also, because a lot of people have left the country and ICE operation. So the total number of people in the labor pool, it has shrunk. That is what has been found according to this labor report. And in terms of mortgage and consumer lending, if this interest rate came down, this 10-year treasury yield came to 4.6%, and then with this mortgage rate relief also, it's been dipped by 6.74%, according to the Freddie Mac respond in 30-year treasury mortgages. So anybody is trying to buy a house, they might get a little relief because rates in last 2 months. So it will give some relief to home buyers. And in terms of consumer credit outlook, the lowest yield it took some impact pressure of the secondary debt market. So the cooling trends it might continue, and it is expected that gradually lowering of borrowing costs, including auto loans, credit cards, and personal line of credit. The consumer credit should also get relief along with the home buyers. So guys, so this is what I have to say about this latest labor reports from BLS. Hope you liked this video. If you did, please hit the like button, and if you like this video, please subscribe my channel. I'd really appreciate it. Thank you, and have a wonderful day.